afternoon, everyone. How are we doing today? If I can just get a quick audio and video check, let me know that you can hear me and see my screen as well. You can just type it in right there to the questions. So let me know we're coming through loud and clear so we can move forward here. All right. Perfect, Arthur. Thank you very much. Okay, well, I'm going to get our recording going here, and we're going to get moving right along here. So welcome, everybody, to the Nadex Application and Strategy webinar series. My name is John Skelton with apexinvesting.com, and today we're going to talk a little bit about trading range-bound markets with Nadex binaries. And, one of the big things about trading is you want to make sure you have, different strategies available to you, not just one. You want to be able to trade in trending markets and choppy markets and range-bound markets. That's what we're going to talk a little bit about here today. So let's just knock our disclosures out real quick. Trading futures, options, or any financial instrument involves risk. It may not be suitable for every investor. And trading Nadex involves financial risk, may not be appropriate for all. And, any examples today that I show you of, utilizing the Nadex platform and entering or exiting trades, that is not a trade recommendation or advice in any way. That's simply an example of showing you how to enter and exit orders on the platform. And as always, past performance not indicative of future results. So, like I said, I'm with apexinvesting.com. Apex and Nadex, two complete separate different companies. Nadex is an exchange. Apex, we're an online education company. We're a group of traders helping traders. We focus on risk management and probability. That's why we love the capture risk products with Nadex. And we're traders just like you. I've been with them now for about almost 4 years now as head of operations, and got a background as a stockbroker and in the banking industry. And I trade Nadex binaries and spreads every day, just like you. And what we're here for is just to kind of give you some free education on, who is Nadex, what are the products they offer, and what are some ways that you can utilize these Nadex products into your day-to-day trading. And speaking of Nadex, if you're brand new, make sure you hop on over and go to nadex.com. And just want to show you a few things here real quick, just to give you a little bit of direction. If you hop on over to Nadex, you can go through, the binaries tab here, the spread tab here, get some great information on binaries and spreads. But right here under the Learning Center, if you go to webinars, this will show you upcoming webinars and let you see, what subjects are going to be covered. You can get registered for them. Right here under Webinar Archive, this is a great tool to go to. If you go right here to Filter by Presenter and you go down and find us right here, Apex Investing Institute. If you've missed some of our previous webinars, you can go back here and watch anything you've missed. All right, and you can go through here and you'll see a bunch of different subjects. We go into everything from, basics 101, how does a spread work? How does a binary work? Starting off with the foundation and basics and building from there. We go over different strategies, different systems, different, top mistakes and some trading mentality. Great information here if you've missed some of those webinars to check those out. And right here under trading platforms, you can go straight to the online platform. Nadex has a mobile platform. I want to bring your attention right here to demo trading platform. Nadex will give you a $25,000 demo account, absolutely free. All you have to do is select a username, fill out some quick information, and hit open demo. And in just a few moments, you'll get an email with a temporary password. You can log right into the demo platform. Once you do that, you can go up here to My Account, go to Settings and Password. And you can change that temporary password to whatever permanent password you would like. And the demo platform is a huge, huge tool that Nadex offers you. And you're crazy if you're not taking advantage of it, because it helps you get familiar with Nadex, the different instruments they offer, different expiration times, entering and exiting orders. It's a great place to try out new strategies and systems. If you're trying out something new and you're still trying to master it, do it with your demo account. All right, don't play with something new and test something new with your live money, guys. That's a very expensive way to learn. For example, the strategy I'm going to show you today. Don't jump in trading that with your live money 2 minutes after you get off of the webinar here. Hop in, trade it in your demo account, test it out, master it, and move over to live. So just another great piece of tools and education that Nadex offers for you there. So make sure to take advantage of them. So again, today we're talking about range-bound trading, kind of how to read the market conditions and know what a range-bound market is, and then some ways that you can trade range-bound markets. The strategy I'm going to review quickly today is called a butterfly strategy, okay? And if you're not familiar with the different types of binaries out there, again, you can go back through the webinar archives and do a little bit of catch-up. And we have plenty of webinars where we talk about the difference between in-the-money binaries, at-the-money binaries, and out-of-the-money binaries. I'm not going to spend a ton of time today going over that, but in a nutshell, I just want to draw your attention to a couple of things here real quick, just to make sure we set the tone here, and so that you can kind of follow along. So, for example, right now, we're looking at the US Tech 100, which is a derivative of the NASDAQ, okay? Right here, the indicative price is 58.27. Now notice on these different binary strikes here, we've got binary strikes from 58.52 all the way down to 57.96. Notice they're 4 points wide, right? And price-wise, we've got anywhere from $5 a binary up to $99 for a binary, okay? But I want to draw your attention to something. Right now, the market's at 58.27. Notice this binary strike right here is at 58.28, okay? So the strike price is very close to the current market price. And the binaries are priced approximately around $50. Now, what is a binary? Well, all a binary is a statement. It's simply a statement, like this particular binary contract. A binary is 0 or 1, yes or no, true or false. This statement says the US Tech 100 will expire greater than 58.28 at 2 p.m. Eastern Time today. It's just a statement. It'll expire greater than 58.28. Yes or no? Will it or will it not? Do you agree with that statement? Yes, it will expire greater than that, and therefore you want to buy if you agree with the statement, right? If you think, no, that statement is not true, it'll be less than 58.28, then you would sell, okay, in a nutshell. At expiration, a binary is worth either 0 or 100. For example, if you were to buy this binary right here, and at 2 o'clock the market expired above 58.28, then that statement would have been true. You would have been correct. You'd have bought it for $44. It'd be worth $100. Okay? If that statement was false, if you bought it saying yes, but the statement was false and it expired less than 58.28, then it would be worth 0. Okay? But when you look at a strike price, like right now the market's come down a little bit, it's about 58.25, and look at this strike price that's at 58.24. When the strike and the market are right close together, you're looking between the buy and the sell side approximately around $50. Well, why is that? Well, because it's kind of a 50-50 thing, right? At expiration, it's either worth 0 or it's worth 100. So before expiration, when it's right there, when the strike price and the market price are right the same, it's worth about $50 because it's kind of a 50-50 chance, right? It's a probability. It's kind of on the fence there. It could go up a few ticks and expire profitable. It could go down a tick and expire at a loss. Okay, so you understand why that's priced around $50, right? Does that make sense to everyone? But now let's look at something else. See these down here that are priced much lower, like this one around $12. What does this statement say? Well, that the US Tech 100 will expire greater than 58.40. 58.40. But right now the market's only at 58.26. So the market has to move up quite a bit for this statement to be true, right? So that's a little bit lower probability. Does that make sense? because when it's priced right around 50, the market just has to move up 1 or 2 ticks, right? But for it to go way up here, that's a little bit further move, so it's a little bit lower probability, so it's priced closer to 0. Okay? What about up here? What about this one that's priced at $76? All right, it's priced a lot closer to 100. Well, but what does the statement say? That the US Tech 100 will expire greater than 58.20, above 58.20. Well, where is it right now? It's at 58.26. That statement is already true. The market's already above that strike price, which means it's going to be a lot higher probability for it to go further or to stay above that, because it's already true. That's why it's priced at 77, which is closer to what? 100. Okay, just as a quick kind of jet tour there, does that make sense when you scan over this, what we call a binary strike ladder? Does that make sense? So you've got a lot of different strikes here, and you've got different prices. And at expiration, that binary either be worth 0 or be worth 100. Okay, same on the sell side. And can you understand why? Show of hands real quick. Any questions on that? Just in a nutshell, does that make sense to you? Where the market is right now compared to that strike price, that's what determines kind of that pricing. Okay, so when you kind of look at this, if you weren't aware of that and didn't understand that concept, or if you're brand new, sometimes you look at this and it's just really confusing. It's like, man, why are there so many options and there's different prices? And now when you come to this binary strike ladder, what's the first thing you're probably going to do? You're going to scan right here, see where's the current price, where's the closest binary strike to that. Okay, it's about 50 right here. So this is kind of like the midline, right? In your mind, you're going to be kind of drawing a line right there going, here's where the market is, right here. These up here are priced a little lower if I'm going to buy because market's got to move. These down here are priced a little higher because it's already true, like it's already in the money. That's why these are a little bit more. That's why these are a little bit less. That's why this is right in the middle. Make sense? Kind of helps this make a little bit more sense right here. Okay, so what we're going to talk about today is utilizing these binaries right in here. Okay, what we call the in the money binaries. So, real quick question though, just to make sure you got this. This binary right here, okay? This statement says the US Tech 100 will expire greater than 58.16, right? Right now the market's at 58.27. So it's quite a ways above 58.16, right? And that's why it's getting closer to 100. Let me ask you a question though. What if the market started to come back down? It's at 58.27 right now. As the market starts to come down, this price would most likely come down as well, right? What if the market dropped from 58.26 and it dropped down to right at 58.16? And I don't mean at expiration, I mean, you know, before expiration. Right now, this binary is priced around 85. But if the market came down from 58.25 down to 58.16, where would this binary be priced at? Yeah, Sharon, exactly. It'd be priced around 50. How do we know that? Because, again, if the strike price and the current market price are right about the same, it's around $50. We've already talked about that, and we've shown you that example right here, right? Because it's right in the middle. Okay? So, real quick question here. Let's just say, for example, that we were going to take this binary, this one right here, okay? And let's just say that we were going to buy this binary, buy one, for $80, okay? At expiration, what's the most this binary could be worth? 150, $200. What's the most this binary could be worth at expiration if we were correct? $100, right? At expiration, a binary is either worth 0 or it's worth 100. So we're risking $80, and the most profit, most we can make is about $20, right? Everybody agree with that? Everybody understand that? Okay, now do we necessarily really like an $80 risk to only make 20? I mean, if I lose one time, then I have to be profitable 4 times in a row just to get back to break even, right? So I may not like that aspect of it. Does that make sense? But what do I like about this binary? Let's take a look at something here. Let me pull open a chart here, and I just want to put one thing on it, and then we're going to piece all this together. Exactly, Sharon. We like the probability, okay, because it's already in the money. All right. Let's see here. We want that right there, and we want the current price. Yeah. Okay. So let's talk about this a little bit here. So here's a quick chart of the Nasdaq. Okay. Right now the market's about 58.21. So if I'm going to buy a binary, I'm saying that whatever strike price I buy, that the market will expire above that, right? So if I buy a binary up here, okay, what am I saying? I'm saying that the market will go all the way up there, right? So it may or may not, but I can get a binary up here, like in the 58.30 area, for what? Like 15 bucks, right? Very cheap. But what's the probability of it really going up there? Well, that might be a pretty big move, okay? I could get a binary right in here, right where we are, for about how much? About $50, right? And if it expires above, I make 50, expires below, then I'm out 50. So where is this one at right here? This one, this 58.16. All right, see that one? I can buy that for about 70 bucks. 58.16. And that one is down here. See that? 58.16. So why do I like that? Well, like Sharon said, probability, right? Which one of these has the best probability without knowing the market direction? Well, this one has the best probability because the market's already above that strike price. What happens if I buy this one right here for $70 and the market doesn't go up anymore? It just stays right where it is and then expires. Am I profitable or not profitable? I'd be profitable, right? Because even if the market stayed right where it was, it expired above this line. What if the market came down and down and down and expired right here, just above my strike? It would still be a profitable binary, wouldn't it? Because the market stayed above. So within the money binaries, we've got some options. The market can go up, the market can stay flat, or the market could even come down as long as it doesn't go down below our strike. So does that make sense? Why those in the money binaries have a lot higher probability, okay? Yes, they have a higher risk, but they do have a lot higher probability. Does everybody understand that and see why? If I can just get a quick yes or no, make sure we're paying attention here, class. Okay. So what are some ways that we could take advantage of that higher probability, but not have such a high risk? Because, you know, I don't want to go in and, you know, get this one for 80 bucks or 78 bucks, let's just say right now, okay? 75, there we go. So if I bought this one at that time for about 75 bucks, how much could I make if I'm right? $25, right? Everybody agree? If I'm going to buy it for about 75, it expires worth about 100, I can make about 25 bucks. But is it necessarily a good risk to reward to risk 75 to only make 25? No, not really, right? Okay. But what I like is the fact that there's about a 75% probability of this expiring in the money, right? So what if I could only risk $25 to make $25? That's what we call a one-to-one risk-reward ratio, right? Can I risk 25 in order to make 25? That's a one-to-one. If I have a one-to-one risk-reward ratio and I only win, or I'm only profitable 50% of the time, where does that leave me? Who can tell me? If I can risk 25 to make 25 and I'm profitable in half of my trades, I'm break even, right? Anthony, exactly. I'm break even, okay? But what if I can risk 25 to make 25, but I'm profitable on 75% of my trades? I have a 75% probability. Well, then that turns break even into profitable, and a nice little profitable, right? Anthony, you agree? Does that make sense? Just that difference there makes a big difference. So that's what we like about these in the money binaries. Even though we're going to be risking about 75 bucks, we like that it's kind of like a 75% probability. So how can we utilize a 75% probability but not risk 75 to only make 25? Okay, so let me tell you, I think you already know the answer. If I were to buy this binary right here for 75, the most I can make is 25, right? So if I bought it here and it goes in my favor or stays in my favor, I make $25. But what if I'm wrong and the market comes down and comes down and comes down and it hits my strike? What is my binary going to be worth if the market comes down and hits my strike? 50 bucks. So how much? So if I bought it, and if the market comes down and hits that strike and I just got out of it early, I exited early, how much of a loss would I take when I exited early? I bought it for 75. It comes down and hits that strike. It's worth 50, so I get out. That's my rule. Yeah, Anthony, so I would have a $25 loss. So does that make sense to everyone? I'm taking advantage of the higher probability, 75% probability trade that could let me make $25. And if I'm wrong and the market comes down and hits my strike, I exit for a $25 loss. So I'm risking 25 to make 25. But I'm not doing that with a 50% probability. I'm doing that with a 75% probability. And then I'm combining that general pricing probability with what my chart and system is telling me. So if I've got a good system or strategy that has like a 70 or 80% profitability rate of calling the direction of the market, and I combine my 70 or 80% strategy with a 70 or 80% probability binary and with a 1-to-1 risk-reward ratio, that gets pretty powerful. Did I lose anyone right there, or did that just make a lot of sense? Does everybody see where I'm going with this? Okay, it makes sense, right? You need to find a good strategy or system that's calling the direction properly. You combine it with a higher probability binary, and then you stick to a rule that lets you do a 1-to-1 risk-reward ratio. Okay, so if you've got that concept, that is huge. Sharon says, this concept has helped me so much. Big difference in the loss you take. Thank you. Yeah, Sharon, you've been with us for a while, and you've heard me teach that quite often as a great way to manage that trade. Okay, so now that you have that concept, this is going to make a lot more sense, this little strategy I'm about to show you. Okay, so we know that in the money binaries are a higher probability. What is a range-bound market strategy? Range-bound markets is when the market's not trending up or down. Okay, it's kind of range-bound. It's a flat market. Okay, and let me just show you a quick example here. Let's pull up. Well, let's go back to the Nasdaq here, and let's right now we've got a little bit of a trend going on. Let me just pull back here and let's look at yesterday. All right. And so yesterday, you know, the market was, you know, kind of popping up here, and then right in here, it started to chop around a little bit. You see that? It's not shooting straight up or shooting straight down. It's kind of chopping around. And we've all seen days when the market does that. Okay? So let's just say, for example, that let me see here. Let's just look at this one. Okay, let me clear this. Let's just look at today. Again, this is just simply an example. So what if the market was just chopping around here? Like we see it's kind of starting to chop now, right? What if we were to just kind of draw a box? Okay? And let's say that we've seen the market just kind of chopping around for a little bit, right? And as it's chopping, we're just kind of drawing our box out, okay? So the market comes up here, comes down. Let's say it comes up here, then it comes down. It's just choppy. For example, if we're seeing that, if I bought a binary down here under this box for about 75 bucks as an example, and the market expires above my binary. Buy it for 75 bucks, it expires above, how much do I make on this binary? $25, right? Because I'm saying if I buy, I'm saying the market will stay above it. But I also see this chopping in this range. What if I also, at the same time, I sell a binary up here for $25? What am I saying when I sell a binary? I'm saying the market will expire above it or below it. Below it, right? So when I buy, I'm saying it'll be above. When I sell, I'm saying it'll be below. So if I know the market's ranging in this range, what happens if I sell one up here and I buy one up here, down here, and the market expires in the middle? Then both binaries are profitable. Does that make sense? Because we know the market's not trending straight up, so we don't want to be directional bias. We know it's not going straight down, so we don't want to be directional bias, as it were. Okay? So in this example, if we had, you know, what would show us this was a choppy day, and again, this was just an example. As you see, it's breaking out here, going up. But as a range-bound day, does that make sense? How you can get one above and one below, and as long as it expires in the middle, both could be profitable. Okay, that's the concept I want to show you here. Now let me show you real quick a quick example of this is one of the charts we use over at Apex. Don't let it overwhelm you. I just want to show you a couple quick things here. This is a volatile day. Notice these boxes on our chart. See these? These are what we call our expected move, okay? Our expected range. And you can see here down from the times, these are like 20-minute boxes. Like let's say you're trading 20-minute binaries, for example. And so at the start of the 20 minutes, this box pops up and it shows you, hey, for the next 20 minutes in the market, historically, the market doesn't historically go above this level, this big of a move up or big of a move down. It normally stays in that box, okay? But you see here how the market's kind of coming up and coming down and coming up to the top of the box and down. Notice this indicator right here as well. This is what we call our expected volume indicator. All right, it looks historically at the historic volume for this, week of the month, day of the week, hour of the day. See this yellow line? That shows you historically the level of volume for this time period. These blue shades show you the current actual volume. So for example, during this time period, was there less volume than normal or exceeding volume than what was expected? Exceeding volume, right? There's a lot more volume in the market than what's normally there for that time of day. What about right here where it's kind of stair-stepping up and it's really getting big? What happens? The market breaks out of its normal expected range. Here where it's really big, the market's breaking out of its normal range. Does that make sense without giving you a big old long training course on these couple of indicators? Just those two quick explanations. Can you see that? So when we're seeing volume really crazy, would we want to do a strategy like I just showed you and sell one up here and buy one down here, expecting the market to stay in that little range box? No. When we see the market hitting highs and lows of these boxes and volume a lot heavier, we're expecting a move or some volatility, right? So we don't want, so what I'm telling you is you can't just randomly go do this strategy and slap on two binaries. You gotta have a reason why. Let's look at one more. What do we see here again? Same chart, right? Okay, and volume's going crazy. All right, there's a different strategy we can do with volatile markets. And I did that webinar not too long ago if you want to go check that out. Now, here's a different chart. We also have our range boxes in this chart. We also have expected volume on this chart. What is the first big difference you see right here on this chart for the volume? Is it big and exceeding? Is it high volume? Is it breaking through the yellow lines right in here? No. Do you see the big difference in those two charts? Right? I just want to make sure you see it. Do you see the difference here? Boom, boom, crazy volume, right? Boom, boom, crazy volume, crazy volume. And what's the market doing? Up and down and up and down and shooting around. Here, do you see that? Now look at the market. What did it do? It stayed right in these range boxes. And then as it started picking up a little here, you see it start to kind of make a little move, right? You see that? So that is one of the ways that when I look at the markets and utilize my charts, that I'm looking to say, okay, I've got several different strategies. I've got a trending strategy, a range-bound strategy, all kinds of different strategies. Which one do I use today? Which one do I use right now for this 20-minute binary, this hourly binary? I have to know what the market's doing, right? And that's one of the biggest ways that I can see that on my chart is these expected ranges and what is going on with expected volume, okay? Because not enough just to see regular chart volume or bar volume. I don't know what that means. Like, what do I have to compare that to? But if I have expected volume in the historical volume for this time of day, this day of week, it tells me a lot what's going on, right? So when I see this happening and not much movement, that's when I would consider a butterfly strategy. Everybody follow me there? Am I talking over your head? Are you having to look sideways at this chart and upside down and say, I kind of see what you're saying here? Or is it pretty clear what I'm trying to show you? So I wanted to make it very clear, okay? That, boom, big exceeding volume, market's moving. Here, it's not exceeding, it's not moving. Pretty simple, okay? So, how would I potentially trade this? Okay, let's say that I'm, we can only see a certain amount of time over here to the left side of the chart, but what was this here? 4 p.m. Okay, so let's say that I'm seeing this market and I'm seeing it. There's not a lot of volume, and then right in here, I had one little kick in volume right after I got in, but I'm seeing this happen. Okay, I'm seeing this happen. I'm seeing no volume, the market staying in between there. That's when I would want to consider a butterfly strategy, right? Does that make sense to everybody? Where I could profit on both sides. The screenshot just, is before expiration, obviously. But look at this particular screenshot here. Okay, I bought one for 82, sold one for 19. What are we ideally looking to do? Let me show you. Let's go back to this example right here, okay? And again, this is not the proper market condition. I just am trying to get this point across to you. So, if I sold this binary up here for $25, I'm risking 75 to make 25. Yes, everybody agree? That's how it works on a sell, right? If I bought this one down here for 75, I'm risking 75 to potentially make 25. Everybody agree? So if the market expires within this box or between my two strikes, how much could I potentially profit by doing two different binaries? Well, I could profit $50, right? So I'd get 25 and 25. All right. So if I bought this one at 75, say the market was right in the middle here. If I bought this at 75 and the market goes all the way up here, this one would have gone up in value, wouldn't it? I bought it at 75 when the market was here. If the market kept going up more, it wouldn't be worth 75 anymore, right? It'd be worth more like 85 or 90 probably, right? We saw it jumping up to that range a minute ago, did we not? Everybody agree. If I bought it for 75, the market creeps up here, it's probably worth about 85 now. Yes? No? Yeah. Okay. But what is this one going to be worth when the price comes all the way up here and hits that strike? I sold it for 25. It's going to go against me and be at 50. Right? No, Omar, I'm not talking about at expiration. I'm talking about before expiration. Okay, like if we're waiting for expiration to happen, and because Omar said 0, well, you'd be right at expiration, yes, but I'm talking about before expiration. Okay, because at expiration, this one at 75 would be worth 100, but I'm talking before expiration. So if I bought this one for 75, expiration's way out here, say. If I bought this for 75 when the market's here, but the market moves way up here, this one's probably worth 85 or 90 bucks now. But when the market comes up here and hits this one's going to be worth what? 50, right? And what am I going to immediately do when the market hits my strike price? I'm going to close it out, right? I'm going to get out of it. Everybody agree? Yeah, Sharon says you're going to lose $25 and you're going to get out of it. So Sharon's right. The market hits this strike, I get out, and I'm down how much? 25 bucks. Okay? And when that happens and I exit this one, I'm going to immediately also close this one. And how much am I in profit on this one? $10 or $15, right? So I would lose 25, but make 10 or 15. So how much am I really down on this whole trade? 10 or 15 bucks. Everybody understand that? Did I lose anybody right there? If I lost you, say something right now so I can clarify it. Okay, so what was my real risk here? Sharon brings up, Sharon, you just set me up. Sharon says, why not stay in the lower one? Well, because Sharon, what you're thinking is, okay, well, the market came up here and hit you and you got out and you lost 25 bucks. Well, why don't you just leave this one open and let it expire and make 25 bucks? That way you're break even. Right, Sharon? That's your question. That's a logical question, is it not? What's the market doing right now in this example live, Sharon? It's coming back down. And what if it comes all the way back down and hits this strike? How much is this one worth? And what are we going to do when it hits this strike? We're going to close this one for a $25 loss. So what do we just lose? 50 bucks. As opposed to only losing 10. Okay? So yes, since you stand to profit 50 bucks, you could do that and potentially risk 50 bucks. But wouldn't you rather have a strategy or system that will let you potentially profit 50, but only risk 10 or 15? Sharon, your question was perfect because you set me up for the next part there. And do you see it now? Because your question was super legit. Why not leave the other side open? Because do you want to get hit on both sides if it comes back down? No. It hits here, exit for a $25 loss, exit this one for a $10 or $15 profit. So you're down 10 or 15 bucks. But if both sides were profitable, you would make 50. So now, how many times could you be wrong and be down 10 bucks to be profitable one time for 50 bucks? You see that? Do you see what we just did there? We gave you a scenario where you could risk 10 or $15 to potentially make 50, right? While utilizing the power of in the money high probability binaries. We just totally twisted it around because what was the situation here? High probability, but I got to risk 25. I got to risk 75 to make 25. I had to risk 3 times more than my potential reward, right? That's what we don't like about in the money binaries. I got to risk 3 times than what my reward is, but I like the high probability. What we just did there was we still utilized high probability binaries, but flipped it around. It's not 3 times the risk for 1 times the reward. We just turned that around into 3 times the reward. Did I lose you on that little word twist there? Or does that make complete sense? Okay. But to do that, to get in there and flip the rules around, to use the high probability binaries with a 1-to-3 risk reward ratio, it all boils down to one thing. The only way to do that is what? To be disciplined, and you absolutely, no matter what, 100%, always, every time, have to follow what rule? Exit at the strike if it goes against you for approximately 50. As soon as you start breaking that rule, what happens? Oh, well, you know, it's coming down to my strike, and okay, now it's at my strike, I should exit. But I don't want to. I don't want to take that little loss. It's going down a little bit more. Maybe it'll come back, and and it goes down, and boom, you just lost $75. Because you didn't want to follow your rule and stick to a strategy and system that gives you a $10 to $15 risk. You were being greedy about it, and you didn't follow your rule. It goes on down, and you lose $75. And you break that again, and you break it one more time, and 75 and 75 and 75. When if you'd have stuck to the rule, you can risk 10 or 15 bucks to make 50. So do you think you should probably stick to that rule if you're going to try this strategy? Yeah. Okay. So that is what we call a butterfly strategy. And like I said, you don't take them blindly. You don't just slap them on every expiration of a binary. Never just take a trade because of a price or probability. You always have to have a reason. You have to look at those market conditions and trade them in the right market condition. Okay, so remember what I talked about early, one of the first things in this webinar. If you do not have a Nadex demo account, you should be scrambling right now to get one, especially after what I just showed you. And what do you want to start doing with this strategy? Do you want to get off this webinar and start trading it with live money here in the next 10 minutes? Or do you want to study your charts, understand that chart, get to see it, and start demo trading it? Make sure that you're calling it right. Make sure you're reading the market right. Make sure you're getting the right strikes. Demo trade that until you're profitable in demo and hop on over to live. Okay? Guys, was that helpful at all? Did that kind of open your eyes to a few things here as far as, you know, with binaries and in the money binaries and ways to trade them and manage them and ways to trade range bound markets? I hope this was profitable for you and kind of helped you see a few different things. Arthur, great. I'm glad, and Omar, Sharon, Anthony, great. I'm glad you see that. It's a very powerful system, okay? Ken says, does the butterfly strategy work better with binary or spreads? Ken, you can do them with either one. With binaries, we call them a butterfly. With spreads, we call them an iron condor. Basically what they are is, if you want to get technical, it's called a premium collection strategy, okay? And it's the same concept. It's just spreads are structured a little bit different, okay? I can't tell you one's better than the other, Ken. It all depends on the market condition, all right? Like when there's big news coming out that could potentially move the market quite a bit, I actually prefer the iron condors with spreads, all right? When, you know, it's very flat markets and, you know, and the implied volatility, it all depends. Like it all kind of depends on the situation and the pricing. I normally kind of look at both, but today we just happen to be talking about the binary aspect, okay? Margot says, you did a video on this a while back and I used the strategy and it worked. Great, Margot, I'm glad you did. Ken, if you want some more info on that, a couple things here. First of all, I've already showed you on the Nadex website where you can go and get the recordings. So again, this webinar is being recorded. If you want to check it out again, just hop over here to the Learning Center, Webinar Archives, and filter by presenter, go to Apex Investing, and this is where the recording will be, okay? You can also Also, hop on over and check us out over at apexinvesting.com. We've got a ton of free education over there and some step-by-step courses. You know, Ken, we've got some videos over there you can check out about the about this strategy and about the iron condor strategy, which is more with spreads. We're doing kind of a big open house thing right now where you can come in and check some stuff out and, you know, check out some of those videos as well. Okay. Let's see here. Yeah, Anthony, it really helps being able to look at volume. Okay. You really got to be able to see that. And let's see here. So yeah, that's where you can go. Visit us over on Apex. Check that out. Check out the open house. Check out the webinar archive on Nadex. And also, if you know, since you're on this webinar, you will be getting an email with a link directly to this recording also. Okay. All right, let's see here. Margot says, I'm new at trading, still don't understand the difference between a tick and a pip. Would you explain? Margot, we've got some videos on that too. You can check those out as well. But for the most part, when people talk about pip, they're normally talking about forex. And when they say tick or point, they're normally talking about indices or commodities. Okay. And, you know, some things are quoted differently. Like, for example, real quick here, if you go over to the Nadex platform, like see this, you know, 58.22, or let me show you something else real quick here. I think I've got, you know, it also depends on how things are quoted. Like right here is a chart of 6A, which is, you know, the Aussie dollar futures. And see, it's 0.7910. Okay, compared to like say oil would be like oil ticks in dimes. You know, it's whatever 0.10, 0.20, 0.30. Okay, a lot of it has to do with the decimal places, but for the most part, you know, to make it simple to start off, just when someone says pips, they're probably talking about forex. When they say tick or point, they're most likely talking about indices or commodities. So, okay, guys, thank you so much for your time. Thank you for your interaction. I hope this really helped you. Hop in demo and check this out. Check out the recording. Hop on over to our site, ask us any questions, and definitely make sure to hop over to the nadex.com website and look for any upcoming webinars